Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Phil Weiss. Hey, Phil.
Hey, Kirk. Happy to be here on this Monday after Thanksgiving. How are you?
I'm doing great. Got a little turkey coma, but otherwise great. No, it was a good Thanksgiving. Took a little time off. It was relaxing. Didn't work for a few days. It was great. It was great. No one else was anyway, so it didn't matter. But
Yes.
everyone was spending their hard-earned money. They were definitely doing that. How about
I
you,
was.
Phil?
It's funny you say that. I was in New Jersey over the weekend. Over the holiday, we went up on Thursday, and on Friday, everybody's running over what they're going to do, and everybody was going shopping except for one of my sons, and I was with him. So the two of us decided to go for a hike instead of go shopping. So, and to me, that was a lot better.
Good for you, man. Good for you. I just bought a house. I need all the sales I can get. We've been waiting, for it's like we've been waiting, and what's funny is I don't really buy stuff. I don't spend money. I don't need stuff. That's just not me. I'm not a stuff guy. There's certain things that I enjoy. I enjoy experiences. I don't enjoy stuff. I don't need a fancy car, fancy house. I don't need a fancy anything like when it comes to stuff, right? Experiences, love good experiences, right? I'll spend money on experiences, but not stuff. But so I don't buy a lot of stuff, right? I don't have my finger on the pulse of things because I just don't care about brands or any of that stuff.
I'm with you.
However, because I moved, I've got to buy a lot of stuff now to fill the new house, which is also stuff. And so, I'm very attuned to prices. Anyway, so we're going out and looking for furniture. And we started a few weeks ago. And it was Black Friday a few weeks ago.
Yeah.
Like it started November 1st. It was crazy. And I've been fascinated by the concept. So, like when we were younger, it was Black Friday and it was like a big deal. Like, oh, like let's wait until midnight and on Thanksgiving, and then we'll go rush the stores for the 5 TVs that are on sale, and we'll fight each other for those TVs. And it's just crazy, right? And I was never into that, other than the humor of the fact that people do that. But obviously, for a lot of people, that was like a big deal, and for a lot of people, that was like a family event. You go get drunk and go to the store, get in line, and get in fights. Like it was hilarious. But anyway, so that was like a thing, right? Even way back. But it always started the day before, like midnight on Thanksgiving, like before the next day, before Black Friday. It was never before that. And stores have just gotten greedier and greedier and greedier. So every year it gets pushed back more and more and more. I mean, you couldn't even decorate your house with a Christmas tree before Thanksgiving. But I drove by a lot of people's houses. They already had the Christmas tree up like 2 weeks before Thanksgiving. Like, what's wrong with people?
Yeah.
Like, which brings up kind of the point I'm getting to, which is if you're a business, right, and you want to have a sale, right, you want to bring people on for the sale. But if your sale is all year long, is it really a sale?
Yeah.
Right? I mean,
Yes.
if it's Christmas before Thanksgiving, is it really Christmas? Like, is it really Thanksgiving? Like, I mean, it kind of brings the point of, are we just watering down the specialness of these occasions? Like, who cares about Christmas if you can have it in July, right? And so I always just kind of scratch my head and just say, isn't that interesting? Because it just feels like everything's getting watered down because it's happening all the time.
Yeah, I hear
Right?
you.
I mean, like Black Friday is not special. It's like, well, it's Cyber Monday. It's the same thing. I was at the store getting a TV, and I haven't bought a TV in like 6 years. But I was at the store getting a TV, and I was looking at it like, I was like, well, is the sale still going on? They're like, Cyber Monday. It'll just keep continuing. I'm like, well, what if I want it on Tuesday? Like, yeah, it's probably going to continue a few more days. I'm like, what the hell? It's just, I don't know. I mean, I'm grateful for the fact that I don't have to pay as much, but it just makes me wonder, like, because you see retail, you see the restaurants, the takeout restaurants, you see retail, they're really struggling this year.
Yes.
And so I wonder, like, how bad is it in the K-shaped economy? Like, is it that bad where they're really struggling? I mean, I've seen some stores and they're just doing whatever they can to bring revenue in the door, but they're not really making a profit. So I don't know. What are your thoughts, Phil?
Well, first, to go back to something you said, I noticed the same thing in my neighborhood. It used to be we pretty much always go to New Jersey for Thanksgiving because that's where my wife's family is. And it had historically been that there were no Christmas lights up in our neighborhood until we came back, and we usually come back on Saturday after Thanksgiving. And this year we had lights that were up before Thanksgiving, and the same thing has gone to the stores. You're right. There's the sales are all the time. It's not just Black Friday. There were a lot of things that went on sale before that. It's changed a lot, and I do think some of these businesses are hurting. There's which is why they do that, and it's also hard too because when things are always advertised on sale, like I always joke about furniture. Like you go into a furniture store and it says it's 50% off, and then you go in a week later and the same item is 40% off, but it's the same price. So I don't even know sometimes what the significance of some of these discounts are because it's just a different percentage to make you feel like you got a deal, but meanwhile they're probably selling it at the same price, because furniture to me is one of the hardest things to price and know what it's really worth, because I don't really have a point of comparison. It's not like I can even go from one store to the next and find the same manufacturer, same item, or anything else to make a comparison. So it just becomes whatever price you can stomach. So I do feel like there's more of that going on too, where everything's put on sale, but you don't know what the real price is anymore.
So that's a great point, Phil. And I haven't bought beds in a long time, but I remember when last time we bought a bed, we had this issue. So the concept you're talking about is what we call a confuse-opoly. Confuse-opoly, look it up. It's actually a legitimate term. No one talks about it, but it's a legit term. And basically what it means is it's an industry that's deliberately confusing, so you can't tell prices and value. Many industries are like this. Healthcare is like this. You ever go to the doctor, you want to know what the cost is? No one knows until after you do it, right? Colleges, what's the cost of a college? What's the value of college? No one knows, right? It's just like, I don't know, I'm just going to pay whatever because I want that diploma. Finance is another one, insurance especially, but finance, no one knows the cost of anything. Like it's just everything. It's basically a commoditized product. And in order for them to make a margin, they make it deliberately confusing. So you don't know what you're buying and then you overpay. Beds are the same way. I remember, must have been like 15 years ago, my wife and I were buying a bed, and it was a holiday. It was like, I think it was whatever, tax-free holiday in the summer or something like that, that Massachusetts did. So we went out and bought a bed. And remember, we went to a bunch of different mattress stores. And I remember going to them and looking at a mattress and be like, oh, this is really cool. Let's go to the other one. We go to the other one. It's the same mattress, but they have a different brand name. And so it's like, well, it's not the Quiet Comfort 2. It's the, plush top or whatever. But it's the same damn mattress, but they have a different name to it. And I asked the guy, I'm like, well, this is the same as the other place. No. We have a unique one. No one else has this one. And they're all kind of claiming like, no one else has this. I'm like, yeah, I'm sure the brand manufacturers are only doing it for you, right? They're not making the same thing and putting another name on it for you guys. And you could totally tell that's what they were doing. But you couldn't technically compare it because they were different. And they were like, well, this is this. And you look at it like, why the hell am I paying like $50,000 for a mattress? Like, what the hell? Like, they're probably buying this for like $50 from, some Chinese factory and upcharging. I mean, we were at Jordan's, and Jordan's is a great place and they do a good job, but they're totally overpricing everything, just like Restoration Hardware. Like if you want to pay 50 times more for furniture, go to Restoration Hardware. Yeah, it's good quality, but my wife was at a Restoration Hardware outlet, or I guess outlet is store, basically where they take the stuff that doesn't sell, like the Island of Misfit furniture. They take it down there, and it was like, she goes down there, it's like this nice chair. It's like 80% off. Well, it's the same cost I'd probably pay at Jordan's Furniture, but it was 80% off. Well, yeah, it actually was 80% off because they do sell it for like $7,000 at the store, but you could buy it for $1,400 at the discount outlet, which is the same damn thing you could probably buy at Jordan's for like $1,400. So, there's this game that a lot of the retailers play, which I've always been fascinated at, and more power to them. I mean, I'm not saying they're bad people; they're just trying to make a buck. But it does make me laugh that there's so much furniture that is so overpriced, and the margins are huge. But if you think about it, they don't sell that much of it. So the profit margins do need to be higher, because if you're only selling one couch a week, well, your profit margin can't be $100. So I understand, I'm empathetic. If the margin, let's put it this way, if their profit margins were like $1,500 for a couch, and they were selling like 100 couches a day, I guarantee you there would be couch stores on every corner. And that's how business works. That's how the economy works, right? If the margins are so fat, you're going to have one on every single corner, because everyone's going to want a piece. And that's why profit margins get squeezed. And that's just how the economy works. So just for reference, don't get all bugged up about it, because that's if what makes a market is that spread. And so if it gets too wide, other people will do it. All right, so let's dive into what's going on in the world. I was playing with a lot of charts this weekend, and love to get your thoughts too, Phil. But here's one on growth versus value. I love this one, because this
Talk
is
about
so
divergence.
True. Yeah, go ahead, Phil. So talk about this.
Jeez, look at that. I mean, they're just going in pretty much totally opposite directions. I know that it's been a while since value outperformed growth, but to see this, I mean, this just tells you that what's going on in the market. There's a lot of people speculative. It's speculative. A lot of these are speculative stocks. Those are the stocks that have higher growth rates. There's a lot less confidence in these stocks that have been there for a long time, that might have fallen on a bit of hard times. And value investing is just really out of style right now. If you didn't think that it was, just take a look at this chart, because it clearly says, I mean, you're going back, 94. I can't tell the dates on there, but
93, 94.
So if you go look for several years, I mean, value and growth have just gone in opposite directions. So value is a really tough way to make money in this kind of market. And that's, the last time I think we saw this, if you go back to the late 90s, when everybody was laughing at people like Buffett, and there were some other guys that were value guys that actually got out because of the fact that value was so underperforming when we had the internet bubble. It feels a lot like what happened then is happening now, because growth is just so out of favor. I mean, value, sorry, is just so out of favor.
Yeah. So for the chart, for the audio viewers here, basically value outperformed growth. It peaked in 94. It bottomed out in early 2000. It peaked around 06, 07, and then it's bottomed right around now. And bottomed, I mean, like a lot lower than growth. And so pretty much since 07, when value peaked, it has just gone basically straight down, and growth has gone straight up in comparison. So what we're talking about here is comparison growth to value. And if you notice that, some of these peaks and troughs are right before recessions, but the growth has just keep going. And so the takeaway here is not that forget about value, although you would have done much better if you had back in 07. You would have just done growth and you would have done fine. But the point is this goes through cycles, and growth tends to way outperform value during bubbles. We'll call it a bubble, because I think we're clearly in one in tech and AI. Or some people call it the everything bubble. Like, there's a bubble in everything right now. I don't think there's a bubble in everything, because I do think there's most stocks, especially value stocks, are clearly underperforming growth. So I don't think we're in an everything bubble, but we are close to that. And I think if we lower interest rates to zero again, there will be an everything bubble, especially in sovereign debt. So I just wanted to point this out. And the people who've been investing in growth obviously have been doing the right thing, because they've been outperforming everything. But it should be acknowledged, the fact that it doesn't just go up forever. At some point, it will revert, and that's sort of been happening in the last 2 years. You've been seeing some spikes with growth, with value, but we're not quite there yet. People aren't ready to just shovel growth off to the side and go for value. I think we got many years ahead of this, unfortunately. I would like to see value pick up again, because if you buy right, there's actually some great stocks out there. All right, let's see what we got next here. We got lots of charts. So here's I wanted to talk a little bit about let's see, Latin America. Um, so this is the Latin American Index. I think it's I forget the ETF. I'll get it in a minute. But basically, Brazil, Chile, Colombia, Mexico, and Peru. The PE valuations are really low, and a lot of these countries, especially Peru, Peru, I think one of their biggest, if not the biggest, company is produces copper. So a lot of people have been talking about copper lately. Like copper is going to start to pick up because typically it's gold first, then silver, then you've got like other metals, not precious metals, metals like steel or copper or things like that. But copper is really called Dr. Copper. Copper is usually a sign that the economy is picking up. So if that's picking up, so this is a little inverted. You know, the economy is going up, but yet it's going down here and it's starting to bump up. So I'm very curious what's going to happen. I've got some conflicting views over the weekend where a lot of people feel like we're borderline recession, but I've listened to a lot of intelligent people over the last weekend, and it's interesting to hear that actually a lot of people are talking about the fact the economy is going to pick up. Now, I still think it's a K-shaped economy. I still think that the poor are going to get poorer and the rich are going to get richer. But it was an interesting argument to think about. And so, while it feels to me like we've been in a recession for a while, like the K-shaped economy, the bottom part of the K, they're definitely in a recession, have been for a while. And I don't think that's going to change. I think we're in a stagflation economy for the bottom part of the K. The top part of the K, I don't think so. So it'll be interesting to see what happens. I think it'll be a more muddle through economy where it's definitely fragmented between rich and poor. But I don't know, Phil. I mean, you're into commodities. What do you think of Latin America? Is this an area that seems interesting to you?
It does, because it feels like there's more opportunities for growth than in a lot of other regions. But I'll tell you that there was a time when I worked for T. Rowe Price and I wrote a paper talking about emerging markets investing. And it's a really hard area of the market to invest in because it doesn't have, it has historically not had staying power. I know that this year, emerging markets has been a good part of the market, but usually good stretches are followed by bad stretches. It's not consistent. It doesn't deliver this. It doesn't have the same type of stability. And part of that's probably because of currencies. Part of it can be because of governments. I mean, you have countries in emerging markets too, like Argentina, where they have constant fiscal problems. Like Argentina has just so much debt. So, and I know that's not in this particular index, but I'm just speaking about emerging markets more broadly. It's an area that I do like to allocate a portion of client portfolios to it, but I don't do too much, just because while I think that there's potential there, we haven't seen consistent returns over long periods of time from Latin American investments.
Yeah, I mean it's interesting. I mean a lot of people aren't seeing the risk in Latin America. I mean this is a chart on Latin America risk pricing, so it's just showing CDS and option volatility, and it's really showing that it's low. It's quite low. Um, Now, of course, you've got news. I don't know if it's news. Everything's news. But I don't know if it's news, but I know Trump's putting some military assets off the coast of Venezuela, and people are afraid that that the risk is going to start to go up in that region. I don't think the risk is going to go up in that region. I think Venezuela's risk is going up. I don't think anyone else is going to have problems over there. And frankly, I don't even know if I think it's just Trump being Trump. I'm not saying he's not going to do anything, but I think for sure there's going to be it's going to be contained to one area if it happens. Trump doesn't tend to be a war president. He tends to be the like what happened over in Iran. You know, like oh, let's just throw a bomb over there and blow something up and let's get him back to the table and that's it. Like you know, he doesn't want a war. Which actually a bunch of presidents have done that. I mean, you look at Clinton, you look at Obama, you know, a lot of Democratic presidents were traditionally anti-war. You know, Democrats are typically anti-war. Now they're pro-war, but at least the party, not the not the voters, but the party are. But I think we'll probably see some conflict over there, I would imagine, if needed, but I don't think it'll turn into a full-scale war. I think that's not Trump's style. If you're being honest, that's not really his style. But the point of this chart is to show that that's not priced in. The market's not pricing any sort of conflict in Latin America. So it'll be interesting to see what happens with that. Also, let's see. Here we go. Here's another version of that. So it just shows the stock market and geopolitical risk. So it's just showing the S&P versus a basket of these countries. I'm going to get the ETF in a second, but it's just to show that international has actually done a lot better than the U.S. this year, and I don't think a lot of people realize that. But it's done extremely well. Let's see if I can find it. Here it is. ILF, Igloo, Larry, Frank. That is the Latin American index. So if you look here, here's the ETF, and this is the ILF versus the Dow. So what this chart shows is how is it doing compared to the Dow. So when this index is going down, it means the Dow is doing better. And when it's going up, it means Latin America is doing better. So pretty much all of this year, Latin America has done a lot better than the Dow. I think when you start to look at how are things doing, we don't talk about this enough on the show, but everything is relative to something else. So if you're looking at relative indexes, what is one thing doing relative to something else? So if you're buying gold, right, and I don't know what gold's priced at today, but it looks like as of right now, gold's priced at 42.80. Okay, so 42.80 is in dollars. So gold 42.80 is the price compared to dollars. So if you have dollars and Phil has gold, then Phil is going to exchange his gold. I wouldn't recommend that, Phil. But Phil's going to exchange his gold for your dollars, and Phil's going to get your dollars, and you're going to get his gold. Now it's relative, right? Phil's going to get 42.80, and you're going to get your gold, right? But if you go in Europe, it might not be 42.80. It might be 3,800, right? And some other country, it might be 5,000, right? In comparison, but the relative value is in comparison to something else. Everything is. If you buy a stock, you're buying a stock relative to the dollar, right? And if you're bartering, you might be bartering gold for silver, right? You might be exchanging goods for goods, and there's an exchange there. So every currency and every asset is relative to something else. For most people, it's relative to your domestic currency. Now, if you're in the U.S., which most of you are, everything is relative to the dollar. You don't see other currencies because that's not the world we live in. If you're in Europe, at least 20 years ago, you were accustomed to exchanging currencies for currencies. If you cross borders, I need Deutschmarks for lira, and lira for pesos, or whatever it was. So that happened a lot, and people are accustomed to that. Here, we're not accustomed to that. So over there, they're accustomed to currency being the same as an asset, and you would exchange it for something else. So everything is relative to something else. Now, if you look at a stock chart, it's always relative to the dollar. But if you create your own charts, and there's some software out there that will do this, where it's relative value. So you look at the US versus international, or growth versus value, or gold versus silver. These kind of charts are very instructive. And they're instructive for this reason alone, is you can tell what's outperforming. Now, it's not that you're going to exchange gold for silver, but it's to show that which one is doing better. Well, is silver doing better than gold? Then you're really in a good stage of the precious metals market. Now, if gold is outperforming silver as it was earlier this year, that means that the market hasn't picked up yet. But as soon as silver starts to outperform gold, now you're on a roll. Now you're in a bull market in precious metals. And when in the final stage, when the miners start to outperform silver and gold, now you're at the final stage of the precious metals bull market, which, by the way, could go on for years, but you're at that third stage, right? Then the next stage is miners. Copper miners would be the next stage, which if you look here, this shows copper miners, the COPX ETF That's an ETF that does copper miners, gold miners, GDX. And it just shows how gold miners broke out earlier this year and copper miners have not yet, but they're getting really close. Based on some technicals, you could say they already broke out. But the point being is they could be off and running relatively soon. You want to wait for it to break out before you invest because you could be early and then it just goes back down. But point being is you want to be aware of how things work relative to other things, because that's how you know. Think of it this way. If Phil and I have $50 each, we have $100 to put into stocks. Let's say we're the only two people in the world and we're bidding against each other for stocks, right? That's a market of stocks. And so depending on what we decide is the value, it will go up or down. But we still only have $100 between us. So we have to decide to divide that money between different stocks, right? And depending on what we want to put where, that will determine the price of those stocks because we are the market. So if you think about it in relative terms, growth versus value, where's all the money going? The money is going towards growth. So you want to invest in growth because that's where all the money's going. You don't want to invest in value. Now, I'm not saying don't invest in value, but relative to growth, that's where all the appreciation is going. So you want to know why NVIDIA went up 100% in a year, or this crazy stuff like a few years ago? It's because that's where all the money's going, right? And it's not going towards like cigarettes and booze because people weren't putting money there, so those stocks weren't appreciating. That's how the market works. If you want to understand the market, you have to understand money flows and you have to understand where all the money's going. And you want to be on the side where all the money's going because that's going to be pushing prices up. Now, I don't know if you guys saw silver over the weekend, but silver started to take off when no one was looking. It's crazy. So silver's got a mind of its own, and I think it's going to go a lot higher. I did want to share this, and here's a relative chart that I was talking about earlier. We were talking about things relative to other things. So here's silver relative to each currency. Now, if you want to know if something's doing well, do this, okay? Take an asset and price it in different currencies. So we used to do this with gold a lot. This one, actually, somebody else did, All-Star Charts did in price of silver. So this is 4 charts. Silver priced in euros, price in dollars, price in Canadian dollars, and price in yen. Now, what it's showing here is silver is taking off in all of these currencies. Now, what this means for you is this is a strong bull market. Okay, if you want to know if precious metals are on or off, look at gold or silver or whatever, or platinum, whatever you're looking at, priced in many different currencies. And what you'll notice is if silver's going up in all those currencies, it is a strong bull market. If it's only going up in the dollar, for instance, okay, it might be temporary. But if it's going up in all of them, that's a really strong buying signal. And right now, silver is taking off in euros, in yen, in Canadian dollars, and US dollars. Okay, gold is doing the same. I just don't have the gold chart. So this is a strong buying signal. You want to be buying silver. Okay, this is why I've been talking about silver all year. It is a very strong bull market, and I wouldn't be surprised if we see it go a lot higher. I think it's kind of gotten a little ahead of itself. Personally, I don't think I'd be highly taking levered bets right now on silver, but I think you could probably get away with it. I just, I think that's a little risk for my blood. I would definitely have exposure to it though. Maybe not over lever, but definitely have exposure to it because it's going a lot higher. So
I live in the great state of Massachusetts. I may be the only one who calls it that, but I digress. The great state of Massachusetts has a commercial funded by the state that says you can't win the lottery if you don't play. For the moment, let's ignore the fact that there's a state-sponsored commercial suggesting that you go out and spend your hard-earned money gambling on lottery tickets with odds of over 100 million to 1 of winning. But it's true, you can't win if you don't play. I'm giving you the same opportunity here in the show. The only difference is I'm not asking you to buy a lottery ticket. I'm only asking 5 to 10 minutes of your time. But I will pay you at least 100 million Zim dollars for your time. We do have some foreign listeners, so if you don't like Zim dollars, we may have some other currencies as well. If you want to earn over 100 million Zim dollars, go to www.moneytreepodcast.com/free money to get your free money today.
Anyway, I don't know. What are your thoughts, Phil, on precious metals? I know that's not really your bag, but what do you think?
So you're right. It's not really my bag, but in the environment that we're in, I know that it's done really well, and I can't argue with taking a position in something like gold in this environment because when we have inflation, it is a hard asset. Like my biggest hesitancy against gold has always been that it doesn't provide me with a stream of earnings. So now I'm just speculating on the price. That's been why I traditionally don't. But sometimes, like I'm not that kind of investor really, but sometimes the trend does become your friend. And that's what we've seen with gold. I mean, I know it's paused a little bit from where it was, but it's certainly a lot higher than it was. I actually wanted to go back to something else that you said though too, Kirk, because you were talking about international and you're talking about things relative to each other. And so if you look at international and if you use like a broad index like IEFA and you compare that to another broad international index like HEFA, the difference between those two is that HEFA is hedged against the dollar and IEFA is not. And now look at the performance, like both of them are up, but IEFA has strongly outperformed HEFA this year because of the fact that the dollar has gotten weaker. So holding the foreign currency version of or the unhedged version of international stocks, you've done even better than if you held the hedged one. For a number of years, that wasn't the case, but certainly in this year, that's turned. So that's like something else that you have to look at is when you're making those international investments, how are you making them? Are you making them in dollars or are you making them in local currency? Because there's going to be times when the local currency does better.
Yeah, yeah. I think it's important to understand currencies quite a bit. You don't have to be, an expert in the way that some people are. Like some people trade forex all day. I'm not that expert, but you want to at least be aware. You want to be aware of what's going on. Like here's a chart that I saw the other day that talks to this a little bit, and this is just showing all the currencies compared to the dollar. So if you look at the dollar is actually not a currency; it's a basket of currencies. If you look, trading on forex, so the dollar is made up of basically 57.6% euro, 11.9% British pound, 9.1% of Canadian dollars, 13.6% of Japanese yen, and then there's other stuff in there too. But it's basically what it's made up of. So if you're looking at the dollar as a basket, you're seeing like how is everything else doing compared to the dollar? Well, if you look at this, you'd say, well, isn't that interesting? And what it's showing is all of these currencies did well this year up until July, and then it's been flat since. Now the question is, on most people's minds, well, is the dollar going to continue going down? Well, I've argued since the summer, no. I think it bottomed out, and I think that's as low as it's going to go. If you just look at the technicals, it looks very much like it's going to start to the dollar is going to start to increase, and these other currencies are going to start to decline. I'm not saying it's imminent, but it seems directionally like that's where it's going to go. So, am I betting on this by investing in these areas? Absolutely not. When I was saying before, you want to be aware of it. So I don't have a dog in the fight in any of this stuff. I don't really care where they go, but I want to be aware because occasionally it does impact other assets in the U.S. I think a lot of people get tied in. Oh, the dollar's going up, so assets are going to go down. Not necessarily. The correlation is actually a lot lower than you'd think. Yes, there is some correlation, but it's not as you might think. So I think it's something to be aware of, but I wouldn't worry too much because we just showed the chart of silver, for example, of silver in different currencies. Well, if the dollar goes up and these currencies go down, you might think, oh my God, the silver's going to drop. Yeah, but what about in other currencies, right? It's so that's why looking at different currencies is helpful. It's helpful to see if an asset's truly appreciating or if it's just appreciating in your own currency because your currency is going down. So this is like 3 levels deep. I'm probably way over the head of most people listening to the show. But if you think of Howard Marks talks about second level thinking, right? There's first level thinking, which is I do this and it does something else. Second level thinking is I do A, it causes B, and B causes C, right? and it's what a lot of people call the unintended consequences. Like something happens and you didn't think about it because all you thought about was B, and really C also happens. This is the problem with life: is people try to do A equals B, and then it causes some bad thing with C, and people are like, oh, that wasn't related. Like, yeah, it was. So if you think that's second level thinking, but then B equals C, but C equals D, and now you're getting in this crazy world like, what the hell's happening? Because it's like 4 levels deep. This is kind of like that, right? And so it's confusing, but you want to. You're not always going to understand it, and it's not going to always make sense. But what you should do is start to think about, all right, if the dollar goes up and gold goes down, that's bad. Well, is gold going down on other currencies? Well, no. Okay, so then maybe it won't go down, right? But you're still using your currency, right? So that's still important, but you want to look at, is there a greater bull market? Because that's really what's important. Because the dollar could keep going up and gold could go flat, or it might even go up, right? That's actually the sign of a true bull market, was when the dollar goes up and gold goes up. That's a true bull market in gold. So anyway, I just want you to think about this, because it's really important to understand how all these things interact, especially if you're trying to invest. Now, I did want to share this chart, and then I want to get into some more with Phil.
One more thing, Kirk, before we leave that. The other thing that also impacts currencies that we don't think about, because there's a lot of things to do, is interest rates. Because the interest rate basically reflects what you're being paid to hold that currency. And when interest rates go down, that should be a bad sign for the dollar, we would think. And there's a lot of other things that factor in too, but it's just another thing. Like the whole idea of second and third order thinking is that you have to think beyond just what's on the surface. You have to dig deeper to try to figure out what else is going on and what else can cause it move. But we can't forget about interest rates when we're thinking about how currencies perform relative to each other. And it's not just US interest rates, but it's also what are interest rates doing in other countries. If we think back a few years when a lot of Europe had negative interest rates. Well, even if with a dollar at zero, that was still better than a negative interest rate. So that helps the dollar. So you have to think about the impact that interest rates can have too. It's not the only factor. There's lots of factors, but it's just another one that can factor in when we're thinking about interest rates.
Yeah,
we're thinking about currencies.
Yeah, and the thing that actually concerns me the most is what people call the carry trade. The carry trade is you're shorting one currency and going long another one. So it'd be like the Japanese yen for a long time, it's been 0% or even negative interest rates. So you're shorting that because that means you're borrowing the yen at 0, and then you're buying the dollar at 4%. And so you're making 4% on this carry trade. And as long as the yen doesn't start to blow out and start to go up in yield, you're fine. And for years that worked, but that's not what's happening now. So the yen is going up in yield, deliberately so. So where are people putting their carry trades? That's what I want to know. When is this thing going to implode? I assume all the institutions stop doing that because it's going against them. But it makes me wonder, like, is it going to blow up? Or are people still doing that? Or have they already removed their positions? Because if they did, I would have assumed that the yen also would have gone up because you'd have to buy it back, and that leads to that direction. So it does make me wonder about the carry trade, and is that going to implode, or are people already covered for that? I did want to show this chart because I'd never seen this, and I was always curious, and I saw this. I'm like, okay, this is interesting. So basically what this is a pie chart, and it shows US stocks shares of trading volume by each bucket. And the buckets are retail investors, long only, hedge funds, bank traders, quants, bank traders high frequency, and quants high frequency. And so looking at this, retail is about 40% of the pie. Quants are about 15-20%, hedge funds about the same, maybe about 15%, long only about 10%, bank traders and quants are about, let's say, 5% each, something like that. They don't give the numbers, but proportionally you could probably guess. The surprising part to me was retail traders have such a huge piece of that. And that doesn't really include long only. Apparently, that seems to be a bucket which is a little bit vague. I thought the high frequency traders were bigger, but here it looks like combined it's maybe 30%, or maybe 25%. It looks like. So I found this fascinating. What are your thoughts about this, Phil? I mean, retail could really move the needle, but it doesn't seem to want to. So maybe it's all just indexing, and that doesn't seem to be broken out.
Yeah, I'm a little surprised by this too. I wouldn't have thought that retail investors are that much, but I guess the reason that retail typically has less of an impact is because of indexing and passive investing. I would think that's it. And then you have people that just buy it and forget it. That's not happening in those other areas, but there are retail investors that do that. And so that part, there's a part of the market. Like if you think about companies and their stocks, like they have a certain amount of shareholders that just don't trade. And so those shares are not part of the active market. So retail investors, I guess, to see it 40% looks high to me. But then if I think about the fact that a lot of retail is not actively investing, either they're just investing in passively in indexes, or they're doing buy and hold. When I look at it that way, maybe it makes a little bit more sense because the active part of retail that can impact the more of the day-to-day movements is much smaller.
Yeah, I would love to get more data on this. This to me is just a fascinating chart, and I don't think it's a secret that money flows move the markets. Hedge funds have known this for a long time, but money flows move the markets, right? Because where the money's going is where the markets are going. And so tracking that's really important. And that's why some of these hedge funds like Citadel bought flows, trades, from Robinhood, and everyone got all up in a tizzy at Robinhood, like they're selling our trades, like the money flows. And like, well, yeah, but that's how they know where things are going. Like, I mean, you could buy it too, you just don't have enough money. So all these things are for sale, but the reality is that you just have to understand where the money's flowing. So I would love to see more data on this, and I'm sure there's a reason why it's not widely seen. But I did want to share 2 or 3 more charts before we wrap it up. So one is there's a big discrepancy between market caps right now. This one shows tech sector versus mid caps. Large cap tech is way outperforming mid caps. You've seen a pretty much for the last 25 years, you've seen a pretty good correlation up until 2021, where tech just took off and the real economy just kept staying flat. And this is the same stuff we were seeing too, is that the real economy isn't really growing, but tech is, and tech is buoying the rest of the economy. So it's just something to be aware of. When tech starts to blow up, that's going to take everything down with it. It doesn't mean that the real economy is going to crater, but it just means that the prices are going to come back to a reasonable level. Also wanted to share this one, which is market cap versus the US S&P. So it's the S&P 100, 500, 400, and 600. 600 small, 400 is mid, 500 minus large, minus the 100 is large, and the large is 100. So you can see how they're all performing by market cap. And if you see here, the small cap is not performing that well. The whole S&P minus the large cap is performing the worst. The best is the 100 largest, and the mid cap has been underperforming pretty much for the last 10 years plus, like 12 years. So it's just something to keep in mind. It's just something you want to be aware of this stuff, because if you're trying to fight the tide, don't. Right? If you're investing in small cap has been underperforming for a long time. And if you think, well, it's been underperforming, I should invest. Like, why don't you wait till it starts to pick up? Because right now, it may go up, but it's relative to everything else. It's clearly not doing that well. You want to go where the money's flowing. And I know this is momentum investing, and those of you who are value investors aren't going to like this, but I'm just telling it how it is, right? We've seen today, value has outperformed growth for quite some time. And if you're a value investor, you're getting your hat handed to you. Now, it doesn't mean you're losing money, but relative to everything else, if everything's up 100% and you're up 5%, you're losing, right? At least in comparison to everything else and inflation. So it's really important to be aware of where money is flowing. Now, I'm not telling you to chase the bouncing ball, right? I'm not telling you to chase the hot dot. I'm not telling you to just, willy-nilly just go where everyone else is going. What I'm telling you is you want to be mindful of this with your portfolio. If you're deciding whether to overweight growth versus value, overweight growth versus value. I'm not saying don't have value. I'm saying if you're looking to overweight certain areas and underweight other areas, this is an important metric. If you want to overweight international because it's outperforming, then you should do that because international's having a hell of a year. Now, it actually had a hell of a first quarter, and the rest of the year has been kind of flat in comparison. But you should be aware of how these things are going. And I'm watching. Is international going to do as well next year? Don't know. But if it continues, I want to be on that train. So those are just things to be aware of, right? And so don't just chase around whatever's going up, but be aware of it so that you're mindfully making conscious decisions about where you're going to be putting your money. And let's see, relative price. Yeah, I think that's it. I think we just got both of them. So final thoughts, Phil, as we kind of wrap it up here.
So I just to follow up on what you're talking about, I get a research report that comes out 4 days a week usually. And so I'm looking here at the one for today. And it's talking about, so last week was an exception to what you're just talking about because the Russell 2000 Growth Index was the best U.S. stock index for the week. It was up 6.3%. Small cap value was up 5.8. The Russell 2000 overall was up 5.5. Then you have the NASDAQ and then Dow Jones Utilities as the worst performer. But if you look at year to date, the S&P 600 small cap equal weighted is up 2.6%. The regular S&P 600 small cap value is up 4. Small cap, this S&P 600 small cap is up 4.5, and the S&P 600 small cap growth is up 5.2. So it just goes to show you how poorly when we look at what the market's done overall. And this is not, as you said, Kirk, this is not something that's just happened this year. I know this. He looked at different parts of the market on different days. And if you look at it by valuation, if you look at it by growth, like large cap growth is actually growing more than a lot of the small caps. And there's a lot of reasons. I think we've talked about some of them before, but you think about it, the fastest growing companies, when they come public, they're no longer small caps because you have the venture investors and everybody else are holding on to, and the original founders are holding on to them a lot longer. They're trying to take advantage of that growth. Apple's not coming public as $100 million company or whatever it was the day that it went public. Apple today, if it was a company, would come public at $50 to $100 billion at least, I would guess. And that might even be low. I mean, I think with OpenAI, they're talking about it could conceivably come public at $1 trillion. We'll see about that, but that's just the way they're talking. So a lot of things are different in terms of what the small cap used to be and what it is today, because now you have a lot of companies that are in small cap. They've been small cap forever, and they're not going to be anything different. There are some areas that have done really well that started as small caps, but it's a lot harder to find them than it used to be. When it comes to all this, make your own decisions, look at all the data, try and make sure you understand the different things that are going on, because it's never just one thing that's causing whatever's happening in the market. So you want to make sure that you dig deeper and not just look at things on the surface. I'm Phil Weiss. My firm's Apprise Wealth Management. I know experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. You can visit our website at apprisewealth.com. That's APPRISE wealth.com to read and sign up for our weekly blog. Thanks for having me today, Kirk. Enjoyed the conversation.
Yeah, thanks for coming on, Phil. And yeah, if OpenAI comes out at $1 trillion valuation, don't buy it. That's all I'm going to say. Just don't buy it. There's so many reasons why you don't buy it, but if that happens, I mean, remember when Facebook came out and then it just tanked, was down like 40 or 50% right away because it was overvalued at the IPO. And so I think if it comes out at $1 trillion, I mean, think of the number of companies that are $1 trillion. Was it like 4? Like, I don't know how many, but it's not that many. It's like Nvidia, Apple, Microsoft. I don't even know, Meta maybe.
And then you've got Berkshire and Eli Lilly.
Are they both in the trillion?
They were. I don't know if
Yeah, so there's
I
probably like
know
a
Lilly
handful.
passed it last week.
Yeah, maybe like 4 to 6 that are in that range.
Yeah, it's not a lot.
So if it comes out, like I wouldn't touch it. I mean, basically, these AI companies are commodities. They are not creating. There's no moat in these companies. And if you think of here's how you should think about investing in AI. If you're investing in Nvidia, okay, like that's a legit reason if AI trend is going to continue. But if you're investing in these companies like Anthropic or OpenAI or any of these or Grok, I look at it this way: you're basically investing in a model that any one of us could replicate, and there are plenty of people replicating these models because a lot of them are open source. So there's nothing magical about it. You can create your own, and you can be in charge of your data, and eventually that will happen. So there's no moat to stop anyone from just replicating those things. Now, here's the takeaway: there's no moat, then there's no value. And right now, I think of it this way: the U.S. government is effectively supporting the growth of OpenAI because we don't want China to beat us in this race. That's effectively what it is, and they're doing whatever they can to support that growth because it's a big battle. And I understand. I'm not knocking them for doing it. I think it's kind of like one of those, do you if you're saber rattling with China and you think China is gonna launch a missile at you first, well, you preempt that by launching first. Yeah, it's kind of like one of those arguments. It's like who's right? I don't know. I don't know what the right answer is. So everyone wants to preempt it, but I did want to talk about this chart before I wrap it up here, and that's real GDP growth globally. And really, what this chart shows is it shows every country and color coded. And the dark green is 6% or more, 3 to 6%, and then 0 to 3, and then there's like 3 countries that are yellow, which is negative growth. But what it shows is all the developed countries, advanced economies, are not growing that much. The average growth of advanced economies is 1.6%. 1.6 for advanced countries, and that's any country that you could probably invest in for the most part. It doesn't include China, although I wonder whether China's data is real. But it doesn't include China, but all the rest are pretty much 1.6 on average. Emerging markets and developing economies are 4.2. So if you really want to know where to invest in a world where the global economy is not growing, invest in emerging markets. Now, emerging markets comes with a lot of risks, comes with a lot of baggage. I'm not telling you to put all your money in emerging markets. I'm definitely not telling you to do that. But when emerging markets run, they really run and they trend really strongly. But when they go against you, get the F out, because you could lose 90% of your wealth relatively quickly in emerging markets. But you could also make a lot of money there. So I'm not saying to put all your money there, but I'm saying you should be aware if you want to put some money, like allocating a portfolio, a portion of it. I don't think there's anything wrong with that. I think it's a good thing. But this is where it gets in the overweight, underweight, right? Overweight emerging markets if they're doing well, underweight them if they're not. Or in my case, I would just remove stuff from a portfolio. It's like investing in like 30-year treasuries when interest rates are 0. You just remove it from your portfolio. There's no upside to that. It's only downside. So when all these portfolios lost a lot of money, like 50% of their wealth, because the treasuries went from like 0% up to 5% in a year, and long-term treasuries lost 50%, the quote unquote safe money. There's certain points you just get out because the risk is too high. I think right now we're at the inverted side of that, where emerging markets, there's a lot more upside. Globally, there's a lot more upside in markets because it's been pushed down for so long. And I think we probably have more upside in a lot of these areas. I struggle with Europe because Europe's not growing, but yet a lot of money is being pushed there because of their defense and other areas. So we'll see what happens there. But anyway, we're going to wrap it up in the interest of time. So thank you all for joining us this week.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.